I just wait. The participants are all entering, so I just wait while that number ramps up. Okay, let's go. Hey, welcome everyone. We have over 100 people registered for this webinar, so I'm very excited about it. I'm going to be moderating the session, and that basically means directing traffic. So when you have questions for our speaker, could you please just put them in the Q&A section as opposed to the chat section? If you want to chat amongst yourselves and say, hey, that's a really good point, have a bit of back and forth, that's fine, but I'm going to be monitoring the Q&A section. I'm going to hand over to Eric and Will in a moment, who's going to introduce our speaker. Just before we do that, take note of February 9th, the hockey game, Detroit Red Wings versus the Calgary Flames. We have a 5 to 7 session for drinks and food and chat prior to the game. And then we have a 7 p.m. game starts. We have lower bowl tickets. Check the calendar. We'd really like you to see you at the hockey on the 9th of February. So check the website, check your email, buy a ticket. I'm going to hand over to Eric Lewis and Will Powers, who's going to introduce David from JP Morgan.
Great. Thank you, Jason. Appreciate the time and great to be with everyone here today. Eric and I just want to first off say thank you for your time and allowing us to be a part of this. We have the honor of bringing David Leibowitz. He's a market strategist here at JP Morgan Asset Management. His work is in large part with the guide to the markets as well as the guide to alternatives, which he will cover here today. If there's anything we can do from a JP Morgan perspective, please feel free to let us know. We're always happy to connect you individually with David as well. So with that, I'll kick it over to David. And David, please take it away.
All right, great. Thanks, Will, and good afternoon, everybody. Hope you're all doing well, and thank you for joining us today. So in terms of the roadmap for today's session, I thought I would start by just talking a little bit about our views on the macro environment in 2023. And then I'm going to shift gears, and I'm going to focus on some of the risks, but some of the opportunities that we're seeing across the world of alternative assets. I'll start with a conversation around real estate, move on for a conversation about other real assets, things like infrastructure and transportation and how they fit into the energy transition. I'll spend some time talking about private equity, valuations, where are they going, and the opportunity that we see emerging in that asset class over the next 12 to 18 months. And then I'll wrap up with a few thoughts on hedge funds and how performance may be a bit better going forward before concluding with some thoughts on private credit. And so if we dive right in here with a 20,000-foot view of the world, what we're showing here is our PMI heat map. Just a quick reminder to everybody on the call, 50 is the key level on the PMIs that separates expansion from contraction. So anytime you see a reading above 50, it means an economy is growing. Anytime you see a reading below 50, it means an economy is shrinking. But for the purposes of this chart, we are showing things as a heat map where green means good and red means not so good. What jumps out at me when I look at the far right-hand side of the chart today is really the notable deceleration that we've seen in economic activity over the course of the past couple of months. And if I were to show you the heat map back in the summertime, it would have been a lovely shade of green. What we then saw was that the colors began to turn yellow and orange alongside the leaves during the course of the fall months, and that has brought us to where we are today, with effectively a sea of orange and red, and most of the PMIs that we track sitting below that key 50 level. And as we've seen the pace of growth slow here, we've been getting more and more questions about the risk of recession. And what I would say about recession risk in the current environment is that it varies depending on where in the world you're actually choosing to look. Europe is an interesting place to start the recession conversation, because had you asked me 6 months ago, I would have told you that recession in Europe was effectively a foregone conclusion. The reality is that they've had a warmer winter than a lot of people expected. They were able to stockpile sufficient amounts of natural gas. And so while it looks like growth is going to be slow and could even be flat in Europe this year, it's no longer our base case that they find themselves in recession. When it comes to the United States, we think that the probability of recession over the next 12 to 18 months is still about 50-50. It's become very popular in the current environment to make the recession call with seemingly 100% certainty. But as I'll touch on over the course of the next couple of slides, we think that the labor market is something that people are misinterpreting here. And we do see the path to a world where growth undoubtedly slows, but perhaps we don't have a technical recession in 2023 and into the beginning of 2024. And then finally, there's the issue of the emerging markets. China is obviously the elephant in that room. China is in the process of reopening its economy. It's going to create a growth impulse, in our view, during the second half of this year. And that's going to help the EM complex more broadly over the course of 2023. And so, recession, which again has become very popular to talk about on CNBC and Bloomberg, I'm not so sure is necessarily a foregone conclusion globally. What I would say here is that I think the key to avoiding a global downturn over the next 12 months is really the US economy keeping its head above water. If the US catches a cold, as we've seen time and time again, the rest of the world tends to get sick. But if the US economy can hang in there, I think there's reason to believe that other parts of the global economy potentially avoid a recession here in 2023. Now, what's interesting about recessions is that they're always a function of when, right? They are never a function of if. But what I find in the current environment is that a lot of people are suffering from recency bias. They hear the term recession and they immediately think it's going to be a repeat of 2008, a repeat of 2020. And they think also that the definition of a recession is two back-to-back quarters of negative growth. So to start, that's actually not the technical definition of a recession. There's a group in Cambridge, Massachusetts called the Business Cycle Dating Committee. These are effectively the scorers of recessions, excuse me. They've been calling recessions for the better part of the past 75 years. And when they think about recessions in the United States, they focus on these 6 variables, things like personal income, 2 measures of employment, consumer spending, retail and wholesale sales, and then finally, industrial production. We're showing those variables as a heat map up at the top. We are showing those variables in terms of their rate of change over the past 6 months down at the bottom. None of this is suggesting that 1, we are in a recession today, and 2, I think it's going to be important to pay attention to the strength of the employment situation, because again, if we're able to add some slack to the labor market without meaningfully increasing the unemployment rate, I think that that's going to allow us to avoid a recession this year, even if other parts of the economy are looking a bit soft. And so what we believe is going to occur is that we're going to see a series of rolling recessions through different parts of the economy in 2023, but it's not entirely clear to us that all 6 of these variables will roll over together, which is what would be required for a technical recession to occur. So the other thing that I think is important to reconcile is what a recession would look like. As I mentioned earlier, recessions are always a question of when. They are never a question of if. And again, people think that when we have another recession, it's going to be a repeat of 2008. It's going to be a repeat of 2020. But unfortunately, we do not see those conditions in place. What we're showing here on this slide are the 4 most cyclical sectors in the US economy. The way I think about this chart is you have consumers on the left-hand side with housing and autos, businesses on the right-hand side with investment spending and inventories. And when we look at the cyclical sectors today, nothing is really looking all that offsides. You have housing and investment spending, both as a share of GDP, effectively sitting in line with their long-run averages. You have vehicle sales, which despite some noise in the data as of late, is currently sitting below its long-run average. And then finally, in the bottom right-hand corner, we have seen an increase in inventories over the course of the past couple of months. If there's one flashing yellow light on this page, it's very much the inventory chart. We know that there's too much stuff. We've heard it from Target, we've heard it from Walmart, we've heard it from Amazon, but this again is a flashing yellow light, not a flashing red light, and mostly because inventories tend to be the biggest swing factor when it comes to GDP. And so if we have excess inventory, that means you're not going to see an inventory build, and that is going to drag on the overall pace of economic growth. So we're looking at a growth backdrop which continues to soften. And what's so interesting is that against this softer growth backdrop, inflation has remained extremely persistent. Now, this is our inflation heat map. Red means hot, blue means cold. You look at the far right-hand side of the slide today, and inflation is basically running at a 40-year high everywhere in the world. There are pockets of the emerging markets that took their medicine in the form of higher rates during 2021, and they're not dealing with the same type of inflation problems as the developed world. But you look at the US, you look at Europe, you look at the UK, again, inflation sitting near the high end of its historical range. And we do think that inflation has peaked. We think it peaked in the US over the summer. We think it peaked in Europe and the UK during the fall. The question is, how long will it take inflation to come back down to levels where policymakers are comfortable? And we're really watching three things to gauge the trajectory of inflation going forward. One, we're watching what goes on in China and the impact on supply chains. Two, we're watching what goes on in the labor market. And three, we're watching whether or not wage growth in the labor market translates into sticky services price inflation. And so just quickly on the first point surrounding China, again, China's reopening its economy. COVID is absolutely ripping through that population. The government seems willing to leave the economy open and not resort to shutdowns and lockdowns like they did during the early stages of the pandemic. But if for some reason they were to change their stripes and go back to that approach to managing the virus, we do think it would disrupt supply chains. And we do believe that there would be a slower deceleration, a slower disinflation in consumer goods prices than what we've currently penciled in. The second thing we're watching is what goes on in the labor market. What we're showing on this chart, the gray line represents the unemployment rate, the blue line represents wage growth, and you can see very clearly as the unemployment rate has fallen from a level of 14.7% in April of 2020 to a level of 3.5% today, wage growth accelerated at first to its most robust pace since the late 1970s and the early 1980s. But since then, you've actually seen wage growth begin to cool. And as I said to a group of clients this morning, there is nothing in any economics textbook that can explain why this is happening. Our interpretation of the situation is that businesses are hoarding labor, right? When people quit, they're not getting replaced, but they're not necessarily laying people off because they're worried about having to hire them back at a higher price. And so the fact that wage growth has rolled over against a backdrop where the unemployment rate is sitting at 3.5% says to us that perhaps the Fed doesn't need to add as much slack into the labor market as perhaps folks originally thought in order to get inflation, keep inflation moving in the direction that they would like to see, which is obviously back down towards that 2% target. So when it comes to is that a question, Jason?
Yeah, I have the first question. It's actually from me, because you said you think businesses are hoarding labor. So I have a two-part question. One is, how does that square with a whole lot of technology companies have announced quite substantial layoffs in recent weeks? And secondly, how does US had very low immigration during the period since the pandemic began, and a number of people took early retirement and never returned to the labor force. So how do those three data points square with the idea that businesses are kind of hoarding labor? They're not, taking people out that they otherwise would. We've had layoffs, people exited the labor force, and fairly low immigration. Couldn't that explain the fairly low unemployment rate?
Partially. So let me tackle the tech one first, because that's pretty straightforward. Tech employment is a very small share of employment in the United States. Tech matters to the equity market, but tech doesn't matter to the labor situation. So yes, Microsoft laid off 5% of its workforce, but that doesn't move the needle at all, right, when it comes to the unemployment rate. On the issue of immigration, and what I think you're getting at is a question about the participation rate. This isn't a post-COVID problem. This is a post-08 problem, right? I mean, the participation rate, people yelled at me for 10 years after the financial crisis that the participation rate was too low. The participation rate is even lower than it is today. And so that's likely having an impact. And, we think that about 2 million workers retired during the pandemic, and they're not coming back, right? So participation looks set to remain low, but it all feeds together, right? I don't think you can put your finger on a single factor. And again, when we look at small businesses, which is really what moves the needle when it comes to US growth and when it comes to US employment, these business owners are very hesitant to part way with their existing workers, right? People are quitting. You can see that in the JOLTS data, and they're going someplace else to arguably command a higher wage, but people aren't necessarily getting laid off, right? And I think that that reflects a concern that if for some reason we see this big pop in economic activity, 9, 12 months down the road, and all of a sudden demand comes roaring back, right? Business owners don't want to have to go out and find additional labor at a higher price. They'd rather, keep who they have, make them wear multiple hats in the time being, and then have at least enough workers to get back up and running when the economy comes out of, recession, slowdown, whatever 2023 is going to hold. The other point I'll make about immigration and the labor force is this is why our view on trend growth has been unchanged throughout the pandemic. We still think the US economy is only capable of growing at about a 2% rate over the long run because productivity growth is lousy. And to your point, labor force growth has been effectively non-existent over the course of the past 15 or so years. Excellent. So the first thing we're watching when it comes to inflation is what goes on in China. The second thing we're watching is the labor market situation, which again, I would argue is the most puzzling thing in economics today. And there's no framework for explaining what exactly is going on. The third thing that we're watching is whether or not those wage increases that we're seeing translate into higher services price inflation. And I know that this chart is a little bit busy, but I think it tells an important story because it talks about the 3 waves of inflation that we've seen since the pandemic began. So you go back to 2021, over on the left-hand side of the chart, about 2/3 of the way down. Where did the inflation start? Well, it started in goods, right? Supply chains broke down. You couldn't move things from A to B. And so apparel, vehicles, so on and so forth, all saw their prices shoot to the moon. The second wave of inflation came at the beginning of 2022. And if you look at the top of the chart, about halfway across, you can see the impact of higher energy prices, higher food prices, higher commodity prices more broadly on the inflation story at the start of last year. You then look in the bottom right-hand corner of this slide and you see where the third wave of inflation is coming from today. And it's very much concentrated in services. A big part of that is housing, which the Fed has said they plan on looking through. But the question going forward is really going to be whether that wage inflation we're seeing is manifesting itself in services inflation ex housing, and is there a risk that a wage price spiral is actually beginning to develop? Because that is what the Fed wants to avoid, right? The Fed is laser focused on preventing that wage price spiral from taking hold. And so what they've done is really, well, it was too late when they got started, but what they've done is all in an effort to prevent inflation from becoming a structural issue, which arguably a wage price spiral is central to that development occurring. And so, the interesting thing about the Fed today is I have a lot of client meetings. People like to tell me what they think the Fed should do instead of telling me what they think the Fed will do. Those are two completely different items, and frankly, only the second is relevant. I'm going back to one of the first things that was said to me when I started working at JP Morgan. Don't fight the Fed. The blue line on the right-hand side represents the Fed's forecast for the funds rate at the end of the next few years. And then the green line represents what the futures market is pricing in for the funds rate at the end of the next few years. What's clear to me is that the market is seeing something very different than the Fed. The Fed thinks they're going north of 5, and then they'll be able to hold it there through the end of 2023. The market thinks that they hike 1, maybe 2 more times, and then actively start cutting during the back half of this year. I'm going to go with the former, not the latter on this one. I think that we need to take what the Fed is saying at face value. I think the Fed is going to get rates as high as they can. They're going to leave them there for as long as they can. And that's why we're not buying into the equity rally that we've seen over the past couple of weeks, because we believe that it's based on a false pretense that the Fed is going to ease policy during the back half of this year. The Fed is not going to begin easing policy until, 1, they are beyond confident that the inflation genie has been put back into the bottle, or 2, they see a situation in the labor market which simply has become too difficult to ignore. And so when we think about the macro backdrop here, it's an interesting one because it's characterized by slower economic growth, very persistent inflation, and monetary policy, which continues to tighten, that's created a series of risks.
12:30. I'm like, okay.
It's also created a series of opportunities. And frankly, when it comes to alternatives, this is an area where there was a lot of enthusiasm over the course of the past couple of years. Forward returns for equities and fixed income have improved, and people have said, well, maybe I don't need alternatives, right? Maybe I can do it with a traditional 60-40 portfolio. We don't believe that's the case. We still think that alternatives are transitioning from optional to essential, but we do think that navigating the alternative landscape is going to be a bit more difficult in 2023 and beyond than it was during the era of easy money, both in the aftermath of the financial crisis, as well as during the early stages of the pandemic. And so let's start with real estate here and just take stock of where things stand. You can see over on the left-hand chart here, where we show cap rate spreads for core real estate, that valuations have begun to look a bit rich. A big part of this has to do with an increase in the base rate. But what I find most interesting is that this aggregate valuation very much masks significant dispersion when one looks beneath the surface. And you look at that chart on the right-hand side, vacancy rates in the industrial space continue to plumb new lows, whereas vacancy rates in the office space continue to set new highs. And so within the commercial real estate market itself, there's a big difference in price between things like industrial assets, warehouses, last mile distribution centers, and things like office buildings, even retail properties. And we're beginning to see some stress manifest itself in the multifamily housing space as well. If we dive in a little bit deeper and think about office, a lot of people have told me that the office is dead. Clearly not. I'm in the office today. As illustrated by the lovely orange chairs in the background. The nature of the office, however, is very much beginning to change. And you can see over on the left-hand side that office leasing activity has, for the most part, plateaued over the course of the past few quarters. But what I find even more interesting is the chart over on the right-hand side. And what we're showing here on the right, this is based on a survey done by CBRE, where basically they said to office tenants, what do you want from your building? And it's very different from what offices have provided in the past, right? They want more flex space. They want more shared meeting space. They want higher indoor air quality. They want on-site food and beverage. Interestingly, if you look at vacancy rates for offices that were built post-2000, they are effectively a third of the vacancy rate of office buildings that were constructed in the 1980s. And so again, the nature of the office is going to change. The office isn't going away because we're a service-based economy and we need to develop our human capital. In-person interaction is really the best way to do that. But again, it's going to be about selecting the right office assets, not buying the sector in aggregate. When it comes to retail, another area that a lot of people told me was dead. If you look at the chart on the right-hand side, what we've done here is looked at the growth in the number of retail establishments over the course of the past 10 years. The majority of that growth has been in service providing establishments, which makes a lot of sense when you look at malls and strip malls and town centers today. People often say, though, that retail is not coming back and it's going to be a casualty of continued growth in e-commerce. And we've really found two things. One, it's very difficult to consume services through the e-commerce channel. Right? And two, more broadly, there are even parts of the goods complex that people aren't really consuming through online retail sales as well. And that's where the chart on the left-hand side comes into play. What we're showing here, the blue bar represents the share that each sector accounted for of overall online retail sales in the first quarter of 2018. And then the gray bar represents that share of overall online retail sales in the third quarter of 2022. Where has the most growth been? In things like clothing and general merchandise, right? Furniture, building materials, electronics. What hasn't seen significant growth? Motor vehicles and parts, right? I doubt anybody on this call orders a carburetor online and installs it themselves. And so the point here is that there are certain goods which are best consumed via that e-commerce channel. There are others that still need to be delivered in person. And furthermore, when we look at where the growth in retail establishments has come from over time, it's very much orienting towards services which need to be consumed in person. And then, is that another question?
Yes, it is. I have a second question, just while we're in the middle of real estate, actually, because we're heading into residential now. So it's a question about, again, about interest rates, because we've got an interest rate sensitive asset now. Someone wants to know, do you think like that there could be even worse, that is high interest rate outcomes than the Fed's currently projecting on the basis of structural inflation in the labour market? So we got this tight labour market. You said employers are not wanting to let workers go. Those workers are able to command a higher wage premium. That could flow through to just continued stickiness in prices. Do you think there's like a structural problem that even the Fed can't fix? Or I guess more specifically, does that mean like the long-term inflation could be 3 or 4% instead of typically 2%?
I think the short answer is no. I think the important thing to remember about wages is that they don't measure level or wage growth. It doesn't measure level, it measures rate of change, right? So just because you're up 5% relative to last year doesn't mean you're going to be up another 5% next year. And that's very much been the story in more of the white collar area of the labor market over the course of 2022. And so, I think, again, my point about the labor hoarding is that people aren't going out. They're not letting workers go because they don't want to have to hire them back at a higher wage, right? If somebody already works for you, you can just say, I'm not increasing your wages, right? I think that happened to most people on this call when they had their conversations over the course of the past couple of weeks. And so, to me, there is not a structural inflation issue here. Technology is disinflationary. Union membership is a fraction of what it once was. Yes, there will be some tangential inflationary pressure from things like onshoring and the energy transition, but I struggle to see how we see wage growth sit at 5% for the next 5 years, right? I do think we're in the process of decelerating back towards more normal levels, which importantly would be far more consistent with the Fed's mandate than where we are today. I don't think we're going to 2% inflation tomorrow, right? But I think that by the end of 2024, we're probably somewhere pretty close to where we were for the better part of the post-2008 cycle.
Great, very clear.
Excellent. And then finally on residential, this is an area where we get lots of different questions. And you can see over on the left-hand side, part of the reason why single-family home prices have absolutely skyrocketed in certain parts of the country since the pandemic began. And you can see over on the right-hand side that, Jason, to your point, as interest rates have increased, right, interest and foot traffic in real estate has begun to decline. A lot of these properties have simply become unaffordable because mortgage rates have more than doubled. I don't think we've teed ourselves up for a repeat of 2008. The underwriting quality is much higher, but I do think that there are pockets of froth on a regional basis. And the areas that we're most worried about are the areas that saw substantial growth, both in terms of the number of homes as well as in population during the course of the pandemic. And so we worry about South Florida. We worry about parts of Texas like Dallas and Austin. We worry about Phoenix and Scottsdale. We don't really worry about Atlanta. There's a pretty good STEM culture there. There's a nice evolving VC community, which we think will help keep housing in that part of the country above water. But we're not worried about New York. We're not worried about San Francisco because, as you can see on this chart, right, home price appreciation has been nowhere near as robust in those parts of the country as it has been in places like the Sun Belt and the Southwest. And so, there will be pain in some of these markets. I don't think we will see pain at the national level. And again, I think the most important thing to recognize is that the pieces do not seem to be in place for a repeat of what we saw back in 2007 and 2008. So we've talked a lot about real estate up until this point. A lot of clients that we speak to, particularly on the institutional side, will say, I like real estate. I've invested in real estate for a long time. I don't necessarily want more real estate, but I kind of like things of that same flavor. So what else do you have for me that kind of looks, feels, and smells like what I'm used to? And that's where a conversation around other real assets like infrastructure and transportation comes into play. Excuse me. And interestingly, there's a direct tie from those asset classes to the energy transition. So starting with infrastructure, people always say infrastructure, it's kind of a new asset class in the United States. It hasn't really been tested. Well, it has been tested at this point. It was tested in 2008, it's tested again in 2020. And what we're seeing from infrastructure as an asset, particularly core infrastructure, and these are private infrastructure assets, not infrastructure companies, is that they provide a steady stream of income, they provide inflation protection, And they also provide diversification and defense during periods of market stress. So you can see over on the left-hand side the relationship between the allowed return on equity for US utilities and the year-over-year change in inflation, right? Basically, if it's more expensive for a utility to conduct business, they can go to the regulators and increase their allowed ROE, passing along that increase in cost to the end consumer. And then also on the right-hand side, looking at utility spending as a share of total consumption, in the United States, consumers spend about 2.5% of their total spending on heating, cooling, and power, right? You may cancel your Prime membership during a recession. You may cancel your Netflix membership during a recession. Most people continue to pay their water and their power bills. And we do think, again, that 2020 was a good acid test, and we saw the defensive properties that infrastructure assets can entail. And this is a significant part of the overall energy transition. You can see over on the left-hand side, additions and retirements to US electricity capacity in 2022. The majority of the retirements, as you can see up at the top, were in things like coal. The majority of the additions, which you can see down at the bottom, were in renewables, things like wind, solar, and natural gas. You know, people always ask me about the energy transition. Will it peter out? How long is it going to take? This isn't something that's going to happen overnight because, frankly, we don't have the infrastructure in place to make that full transition anytime terribly soon. But I'm a big believer that in the long run, economics tend to trump all. And what we're showing over on the right-hand side is the levelized cost of energy across a number of different sources over the course of the past, call it 15 or so years. There is a clear and distinct cost advantage in things like wind, solar, and natural gas relative to things like coal and relative to nuclear assets as well. And so I think in the long run, pricing reigns supreme. And while this energy transition will take time to play out, it will play out over the longer term. But as I mentioned, a big piece of this has to do with infrastructure. We don't have the infrastructure in place, and that is infrastructure that needs to be developed. So whether it's the number of EV charging stations, right? Projections show that we need to add, close to 800,000 EV charging stations to get to where folks would like us to be by the year 2030. You can see over on the right-hand side, net power balances by state, right? California is a net consumer. Pennsylvania is a net producer. We need to figure out how to create more balance in terms of where power is generated and where it is consumed. And so at the end of the day, all of this is going to require investment in infrastructure assets, again, tying that asset class directly to the energy transition. And we think that there's a story here in transportation as well. Obviously, natural gas is front of mind given what went on in Eastern Europe back in the beginning of 2022 and what's been going on in Europe more broadly over the course of the winter months. We think that there's an opportunity here. We think LNG is going to be increasingly used as a source of energy, and we're going to be using more efficient types of ships to move that LNG around the world. If you look at the bottom right-hand chart, you can see that while a third of the fleet is less than 5 years old, right? Kind of half the fleet is more than 10 years old, and these are ships that usually only have about a 20-year life. And so these ships are going to age out. They're going to need to be replaced, and we anticipate that they will be replaced by more environmentally friendly and efficient modes of transportation, things like the diesel two-stroke engine, which we show up at the top right-hand corner, has been growing its share steadily over the course of the past couple of years. So there's a way of playing this. Yes, go ahead, Jason. You're on mute.
How long have we been doing these Zoom meetings? I have another question in the chat. So it's a counterpoint to the energy transition. So we've seen lots of coal retired, lots of solar and wind and natural gas replacing that coal. The question is whether there could be a constraint on how much of that high emissions energy generation is replaced, given the need to develop so much infrastructure to transport energy across locations. And specifically, the person says, well, we don't have as much solar and wind here in Michigan. The implication would be we have to transport that energy from somewhere else from these renewable sources. Is there any potential threat to this energy transition being impeded by that geographic constraint? there are areas where there isn't enough wind, there isn't enough sun, the transmission network would have to expand to a huge degree. Is there any potential risk that this transition does peter out to less than you're expecting?
I don't think it peters out. I just think it takes longer than people expect. I mean, look at the situation in the Nordics, right, between Norway and Denmark. They share power via an underwater cable because sometimes there's more wind and sun in one place than there is in another. And so, I don't really buy into the idea that we've made this energy transition by 2050. I think it's going to take much longer than that. But I would push back on the question and go back to what I said earlier, which is that over time, pricing and economics, in my view, will trump all. It's more efficient and arguably more profitable if you're an energy producer to rely on these sources of renewable energy over time. And so, are we going to wake up in 5 years and everybody's going to be driving a Tesla and there's going to be an EV charging station on every corner and we'll all have solar panels on our roofs? Absolutely not. But do I think that over time we get to where we need to be? Absolutely. The one interesting point is about bridging that gap. And I think that that's the real genesis of the question that's being asked, right? The share of fossil fuels in primary energy use is still about 80 or 85%. And it doesn't look like that's going to change at any point in the next couple of years. Meanwhile, there has been a dearth of investment in traditional energy sources over the past, call it 10 or so years. And so in order to get from where we are today to a more sustainable world down the road, we're going to have to intermittently invest in higher emission sources of energy. And so I recognize that the path there is going to be complicated, but I do think it's important to recognize, one, the economics of renewable energy, and two, the fact that policy initiatives and consumer preferences have finally become aligned. And that can be a very powerful thing when policy wants something to happen and consumers want something to happen. It oftentimes will play out. It's a very different place from where we were on the energy story specifically just a couple of years ago.
And a follow-up to that, and I think I already know your answer to this, is that someone has raised a question about will the ESG pushback affect financing of the renewable sector? What I think the question means is that there were lots of investors that were hot on ESG metrics for a while, but in recent times, people have been less focused on these metrics, considering them somewhat window dressing. The question is whether this change in focus is going to affect financing. I think from your answer, it doesn't, because you're forming a view based just on economics. But do you think a change in focus on ESG metrics matters at all? Not really. And to be blunt about it, I can't tell you what ESG is. I don't think anybody can give you a consistent definition of what ESG is. I think we all believe that this concept is the right thing to pursue in the long run. But I mean, we've dealt with this over the past couple of years, right? Working on our own products, making sure that in Europe they're ESG compliant. It's like, what is the definition? And the problem is we don't have a standardized definition in the current environment. And I think that that's why a lot of people have pulled back, in addition to the fact that there was a breath of life to traditional energy in 2022, given what happened in Eastern Europe. But I think, again, in the long run, it's about the pricing, it's about the economics, and this is more of a hiccup on the way that we will deal with. But in the long run, price trumps all. Excellent. So maybe just wrapping up on the real asset conversation, because I do want to be cognizant of time. The final point I'll make, and this pertains to the energy transition, is when we look at wind, which obviously gets a lot of attention here in the United States, what we're seeing is that wind farms are being located in deeper bodies of water and also further from shore. And that's what we illustrate over in the chart on the right-hand side. That means servicing these assets is increasingly difficult, and you can't necessarily go from port to pole every single day to service a turbine. And so one of the opportunities we're seeing in the transportation space today is actually in ships that go out into the ocean, they clip on to the post that has the wind turbine up at the top, and these folks effectively live at sea for weeks at a time, servicing these assets in a more effective and efficient way. And so, I think the takeaway here from my vantage point is, yes, there are challenges to the energy transition.
Yes, it's going to take time to play out, but in the interim, there are ways of gaining exposure to that transition in portfolios in almost a first derivative type of way, and real assets, namely infrastructure and transportation, are great ways of adding that into within the context of a diversified portfolio. So,
and one more question on this energy, and this is a slightly different sort of question. The question has been raised that as we transition towards more solar energy, we need more natural resources, and these are quite unique natural resources, and a lot of them come from China.
Yep.
So the question is, do you have any view on how US-China relations might have to be modified in order to improve trade flows between the US and China, given that trade relations economically and politically between the US and China at the moment are not great?
So this is a great opportunity, one, for me to plug my guide to alternatives, which is where these charts come from, because we actually have a chart that shows where rare earth metals are located globally, and some of the challenges to the energy transition with respect to sourcing the required materials and commodities to make solar panels, so on and so forth. The US-China question is interesting. Frankly, I think we're headed into a multipolar world where on the one hand, you have the US and Europe, and on the other hand, you have China, Russia, and India. That said, I mean, it's the US-China relationship is still very symbiotic. I know that it's not necessarily as clean as it once was, but they need us and we need them. And so I do think that at the end of the day, cooler heads will prevail. There will be some hiccups along the way. There will be some challenges, but it would be in China's best interest to take advantage of the resources they have and engage with those counterparties that are looking to leverage those resources as part of the energy transition, just as an example, right? Otherwise, China's just going to be sitting on a bunch of rare earths and nobody's going to want to buy them. And so they need the US, much like they've needed the US when it comes to low-cost goods. I recognize the relationship is a little bit icy today, but I don't think that the whole thing breaks down and that we're unable to build solar panels because we can't get our hands on the right materials. So with about 15 minutes remaining, I want to shift gears and talk a little bit about the financial asset side of the alternatives universe. I'll start with private equity, then talk a little bit about hedge funds, and finally wrap up with private credit. 2022 was a challenging year for all parts of the capital markets. It actually ended up being an okay year from a deal activity perspective in the PE space. You can see over in that chart on the left-hand side, deals were basically in line with levels that were last seen back in 2017, which is better than what we feared, going through the first half of last year. We thought the way things kicked off, it was going to be absolutely dismal. And frankly, things shook out a bit better than we expected. Still a tremendous focus on technology, still a tremendous focus on B2B. The issue last year was that although deal activity looked okay, liquidity events were few and far between. And you can see exits over on the right-hand side. Effectively, the IPO window was closed. You were either selling to a corporate or selling to another GP. That was the only way to exit an investment for the most part in 2022. And a big part of what's plaguing private equity today is that valuations are rich and valuations are yet to adjust. You can see over on the left-hand side where we illustrate buyout multiples for US LBOs, the stability in that multiple over the course of the past couple of years. But then you look at the chart on the right-hand side, and clearly there is a negative relationship between corporate bond yields and the multiple being put on LBOs in the United States. And our work suggests that there's about a 2 to 3 quarter lag between what happens in the public markets and that's showing up in the private markets. And so by our lights, the start to this year is going to involve write-downs of private equity assets. And to an extent that this has already occurred in the venture space. And more importantly, what you're seeing is that GPs are changing their approach, both in terms of the size of the deals they're doing, as well as the style of the deals that they're doing, given a more challenging environment here in 2023. From a size perspective, focusing on smaller deals, right? The $1 billion plus deals that we saw in late 2020 and 2021 are effectively nowhere to be found. And from a style perspective, you can see over on the right-hand side, a much greater focus on add-ons, platform creation, growth equity, so on and so forth, right? Not a lot of focus on traditional buyout, given where rates are today, and on top of that, given where private asset values continue to sit. We do think this will create an opportunity not only for funds that are in the process of raising capital or perhaps deploying capital during the back half of this year. We also think it'll create an opportunity in the secondary market. And one of the things that institutions in particular are suffering from today is the denominator effect, right? So their public assets went down, their private assets didn't, and now everybody's overweight privates. As they think about rebalancing the book this year, I do think that secondaries are going to come into play. Secondary volume in 2022 was effectively on par with what we saw in 2021. And you can see over on the right-hand side that although pricing has improved in places like venture, pricing is yet to improve in places like buyout. And we think as that shoe drops, you'll see more activity in the secondary market. There have also been a bevy of funds raised as of late that are primarily focused on secondaries. And so this is a big area of focus for us in 2023, and it seems to be a pretty big area of focus for the market as well when we think about the next 12 months. Now, turning to hedge funds, hedge funds have basically become a bad word in the investment universe. You go into a client's office and you say, what do you do in hedge funds? And the answer is usually nothing. Well, we actually think that one, hedge funds have delivered over the past couple of years, and two, the outlook for hedge funds is finally beginning to improve. So this first chart just shows a rolling correlation between a 60-40 stock bond portfolio and the index of global macro hedge funds. And you can see that during times of stress, whether it was 2022, 2020, 2015, the Eurozone double dip, right? Macro funds have provided diversification relative to traditional stock bond portfolios. And so in the aftermath of a year where if you were purely a stock and bond investor, there was really no place to hide, we do think people will be looking for alternative sources of diversification. And we think hedge funds broadly, but macro hedge funds in particular, can very much be a source of diversification going forward. We also recognize that hedge fund performance benefits from environments of higher volatility. And if you look at the chart on the left-hand side, what we've done here is taken the average hedge fund return, depending on the level of the VIX. And then on the right-hand side, we've shown the relative performance of macro funds to the broad hedge fund universe overlaid on the VIX. The takeaway here is that generally, higher volatility environments tend to be supportive of hedge fund performance, but not all hedge funds are created equal. And again, macro funds benefit disproportionately in environments of higher vol. And so when we think about the opportunity for hedge funds going forward, one, we think that volatility will persist, and that should very much be a tailwind for performance. Two, you look at the level of short-term interest rates, right? For long short funds who are posting collateral, now they're actually going to get paid on that collateral in a more meaningful type of way. And then finally, you look at dispersion within the equity market, dispersion within the credit space. And while certain areas like investment grade look somewhat tight, areas like CLOs, levered loans, looking more interesting from a dispersion perspective, which in an environment where there actually is a cost of capital, which is the environment that we're in today, that creates winners and losers. That creates differentiation, and that in turn helps to support the performance of active managers. And so we do think the clouds are beginning to break over the hedge fund universe broadly, and our best ideas for 2023 are really concentrated in the global macro space, as well as in the relative value space across both credit and equities as well. And so finally, I'll just wrap up here with a few thoughts on private credit. Obviously, the Fed did a lot in 2022. The Fed has told us they are not done, and as I discussed at the onset of our conversation, I would agree that there's more room for the Fed to tighten this year. In general, we view private credit as being a relatively resilient asset, particularly things like direct lending. And that's what we're showing here on this chart. People always ask me the question of public versus private. And, to be honest, today I'd be buying public equity versus private equity, but I'd be buying private credit versus public credit. I recognize that there's been growth in AUM. I recognize that there's been growth in the number of managers, but there are still relatively high quality strategies out there. And you can see that illustrated on page 49 from our guide to alternatives. So what we've done here on this chart is looked at the performance of different fixed income asset class, different fixed income sectors across a variety of different macroeconomic environments. We used the ISM Manufacturing Index as a proxy, and then basically looked whether it was above or below 50, and then subsequently rising or falling. And you end up with environments of expansion, late cycle cooling, turnaround, and recession. You look at expansion, direct lending has historically outperformed. You look at late cycle cooling where we are today, historically direct lending has outperformed. During recession, direct lending trails investment grade and 10-year treasuries, which frankly makes sense, and then trails high yield and levered loans during periods of turnaround. But for the most part, direct lending performs well in a variety of different macroeconomic environments. There is manager risk there, right? I'm not saying that you can just throw money at the asset class and you're going to get a robust yield and you're not going to take on a significant amount of downside risk. But we do think in aggregate, the quality of true middle market direct lending is superior to what we're seeing in the broadly syndicated space. And that's reflected in a number of different ways. One, the stability of default rates down in the bottom left-hand corner. Two, the much lower share of cov-lite issuance, as we show in the bottom right-hand chart. And all of that has very much come together in the chart in the top left-hand corner, which shows that as large corporate loan yields backed up substantially over the course of 2022, true middle market yields exhibited a relative amount of stability, again, suggesting to us that at the end of the day, these are simply higher quality assets. But there will be challenges and there will be stress across credit markets this year. I mean, the Fed doesn't do 400 basis points of tightening in 6 months without something beginning to break. You can see the surge in distressed loan volume over in the chart on the left-hand side. And what's so interesting is that when you look at where the sector composition of these distressed loans, it's primarily concentrated in the place where private equity investors were most active over the past couple of years. Things like software, IT services, healthcare, media. We have another chart in our guide to alternatives that looks at yields on sponsored back versus non-sponsored back loans. Non-sponsored loans are trading at far lower yields than their sponsored back counterparts. And so there's clearly risk in what the private equity community has done with the private credit community over the course of the past expansion in particular. But again, we think that painting with broad brushstrokes is somewhat difficult and dangerous. And we do believe that the right managers will give their borrowers flexibility, they're underwriting higher quality paper, and that will be able to remain as a source of both diversification and income across the coming soft patch in economic activity, while simultaneously we do think that an opportunity is being created for distressed and special situation managers as well. And so with all that said, I want to thank everybody very much for their attention this afternoon. I'm going to pause there. I know we took some questions throughout the course of our conversation, but Jason, maybe I'll turn it back over to you to hit on any final questions before we call it a day.
I have no questions in the chat, in the Q&A. Some may come through in these last couple of minutes, but I have a question because the chart you have on there I find fascinating. So I have two questions. I'll do the first one. That increase in the distressed loan volume, which has been consistently increasing since January 2022 all the way to that high number in October 2022, does that chart go back further? Like, is this very large increase in distressed loan volume, is that anomalously high, or is that normal if we look back over a longer time series? You're on mute.
Sorry about that. It was not enough Zoom meetings over the past 3 years.
Yeah.
I still haven't figured out mute. It's low compared to 08. Not low, but not as high as what we saw during the financial crisis. When you look at the volume relative to prior periods of economic stress, it feels a little bit more consistent with levels that we've seen. But I think importantly, we've kind of only just begun to see this stress begin to materialize. And so my thought here is as we move through 2023, that number is going to continue to move higher. I don't think we hit 08 type levels, but I do think that you will see more distressed loan volume than you saw, say, in the late 1990s around the tech bubble, or in the mid 90s, so on and so forth. The problem is the data starts to break down, right? The further back you go, the less robust the data gets. And so there's only so far back we can look, but I would say that this is definitely an opportunity which is emerging relative to levels that have been seen historically.
Right. And so you said that in this environment, you like private credit as an equity class. There's variation across the quality of these managers. So what's the metric that I should use as an investor to identify the manager that I want to invest in private credit?
So I think you just need to make sure they have a process. You know, what we've seen in terms of private credit over the past couple of years is, you know, the banks had stepped out of lending in that space. There was still a lot of demand for capital, particularly from private equity firms. And so if you stepped in with capital, right, you could kind of do whatever you wanted, and you didn't have to necessarily worry about the underwriting quality because there was plenty of demand. I think you want to own managers with a proven track record and a proven process, and managers who aren't chasing, you know, whatever the popular trade is at any given point in time. And so, you know, again, that was kind of the point I was making earlier. We've seen significant growth in the asset class, and, you know, when asset classes grow the way that they have, that's undoubtedly going to create a handful of warts. I think you want to look at managers with, you know, diversified borrower bases, again, a proven and time-tested process, and frankly, those that are recognizing where the economy is headed and not continuing to add risk to portfolios in an effort to maintain a given level of yield. I actually think that some of the best managers today have been going for those singles and doubles, saying, I'm not going to be able to generate 10% in this environment because I don't want to be dealing with a default over the, you know, 3 to 4 year window that I'm lending to these companies and these borrowers. So, you know, as is true in all alternatives, manager dispersion is much wider than what you see on the public side of the ledger. And so maybe that's a perfect point to end on. You know, allocating to alts, it's always a two-step process, right? The first is figuring out what the problem is you're trying to solve, or what the challenges you're looking to address, and backing into the asset which provides that solution, right? Because private equity is very different than infrastructure, which is different from private credit. But then step two is finding the right manager, because dispersion in private equity, right, is 10 times dispersion in public equity. And that means that you can make a lot of money, but you could also find yourself disappointed if you pick the wrong captain of the ship.
Right. Final questions. This is a quick one. We have a question. Commodities and the US dollar. Is in particular gold and commodities. Thoughts on direction of those things?
So the dollar, I think, is going to be range bound. I think, you know, growth differentials, rate differentials between the US and the rest of the world continue to narrow. That's going to put some downward pressure on the dollar. Putting some upward pressure on the dollar is the continued increase in uncertainty. And so if you think about the dollar smile, there's a bit of a tug of war, which is beginning to occur. So we think in the short to medium term, the dollar is range bound. Longer term, we think that the path of the dollar is lower because of the US's chronic current account deficit. And then on commodities, I think that if China really reopens with gusto during the back half of this year, you probably see a bit of a pop in the commodity complex. My general view there is that we're probably not going back down to where we were pre-COVID, but we don't necessarily need to sit where we were in the immediate aftermath of Russia's invasion in Ukraine. You know, I think oil is going to trade between 70 and 90. I think there's a little bit of wind that can come out of the sales of natural gas. I think food is one area that's going to remain relatively elevated. Food inflation and prices will remain relatively elevated. And then we see a structural opportunity in some of the industrial metals, you know, things like copper, where you could have a buying opportunity if it looks like the global economy is in fact slipping into a recession at some point later on this year. And so, you know, not a strong directional view on commodities in the short run. Recognize that China could be a little bit of a tailwind in the back half of this year, but thinking about it more on a industry by industry and sector by sector basis going forward, where we see different trends for, say, energy than we do for things like agriculture. And
last question. All right, this is where the rubber hits the road. Someone wants to know, of all these alternative asset classes over the next 2 to 3 years, pick your favorite.
So I think vintage 23 and vintage 24 for private equity are going to end up being pretty good vintages. And so I'm going to say, despite where the valuations are today, if there's a fund that's raising capital, I think that that's going to be an opportunity. You know, on the lower vol on the income side, I would say infrastructure. But if you're trying to enhance returns, private equity. If you're trying to diversify and generate more income, I'd say infrastructure.
There you have it, folks. David, thank you very much for your time. That was absolutely fabulous. You heard it there for everyone. Buy private equity. If you're defensive, buy infrastructure. If you're in between, I think you want to buy private credit. Is that right? In between those two preferences?
I think that sounds
If you
about
want,
right.
for higher returns, private equity. For defensiveness, buy infrastructure. If you're in between on your risk preferences, private credit. Thank you so much. We hope to see you all again. Come to the hockey on the 9th of February.
Thanks all.
Thanks, folks.